Good afternoon. Welcome to the first session of BOH 2025. This session is labeled as Deals, Dirt, and Design, getting projects done in today's market, navigating capital, construction, and coordination from concept to completion. I'm going to get the words out properly. It's just going to take some time, but I'm working on it. With me today, and we'll start off by everybody introducing themselves. With me today, starting from the far end, we'll work that way, is Ben Grunwald from J. Frankel Architects. You must have figured out that he must be an architect. Second, coming one closer to me, is Shaya Sonnenschein from Andar Real Estate Capital. I assume they like giving out money or something to that effect. In the center is a gentleman by the name of Larry Hansen from Hansen and McMonagle. Oh, I got that one right. That was pretty good. An attorney, and he will tell you more about what he does. And next to me is a gentleman by the name of Marc Herskowitz from Infinity Land Services. I got the name of the company right this time, right? Good. Okay. From Infinity Land Services, title company, and I'm sure more. So first and foremost, thank you to BOH, and thank you to Powwow, and as well, thank you to Joel Wall, Yehuda Susskind, and Josh Funfetter, who arranged this show and this session as well. Ben, why don't you start off telling us a little bit about yourself so everyone knows who you are and what you do.
Ben Grunwald, we J. Frankel Architects. We're an architect city in Brooklyn. We mainly do projects in the 5 boroughs, a little bit in Jersey, but mainly in the 5 boroughs. We like to design projects, but we understand that there's all different kind of projects. We all want nice projects, but mostly it needs to make financial sense. As I spoke over here, and I'll let you take it from here. At the end of the game, as an architect, we understand that if there's no money, then it can't continue. So it all has to make sense financially.
Thank you, Ben. Shaya, tell us a little bit about yourself, please.
My name is Shaya Sonnenschein. I work at Andar Real Estate Capital. We are a full-service capital firm brokering deals, primarily debt, but everything along the gamut. At this point in the history of real estate, capital has never been more complicated. And the reality is that without being able to really understand the structure, really creatively design the structure of the financing on a deal, it becomes quickly untenable, and the result is one that ends up wasting people not just money, but time and effort. And the goal of good financing today is to be able to get people through even when interest rates may not be exactly where they want them to be.
Thank you. Larry, take the show.
Good afternoon. My name is Lawrence Hansen. I'm a commercial real estate developers counsel. If the developer is the owner of the football team, I like to think of myself as the quarterback, and I try and coordinate the plays to get all of these guys involved in our transactions and to get from dirt to tower to get buildings built. So I primarily focus on transactional work, including the financing, clearance of title, even starting as early with the architects, with architect massings, and really just understanding the transaction and putting a game plan onto the field.
Thank you. Mark?
Good afternoon, everyone. I'm Marc Herskowitz from Infinity Land Services. We are a 22-year-old full-service national title company, and I deal with some of these gentlemen on a regular basis to help get deals from dirt to tower. Throughout the financing and the closing and the construction, I think the developers are pretty much stuck with us to get their deals funded and endorse policies to include all the construction loan, and that's it.
Thank you, Mark. The difference between Mark and Mark is that's Mark with a C and this is Mark with a K. I'm Marc Hertz. I've been doing this. October 31 will be 41 years that I'm doing this. We handle violations. Marc Hertz Group, we handle violations liens, city liens, lead-based paint testing, representation in front of ECB. We only work in the 5 boroughs. We do compliance, and we do full expediting under 4 different companies, all beginning with the first 2 words, for whatever cockeyed reason, by the name of Marc Hertz, which I don't know why. Thank you for coming, and thank you for being here. So, gentlemen, we all know that finding development sites or investment properties with an upside potential is based on the 3 L's: location, location, location. Or as they said when I was going my real estate license, situs, which is the Greek word for location. How have things changed today when one finds a location that they think may be good, and they think may be something they can make money on? Whom do they need to contact first? Whom do they contact, and how do they move the deal along to get going?
Probably me.
Okay, good.
So I generally am the first phone call, and I'll walk you guys through some of the first conversations that I end up having with property owners. Generally, the first question is, what do you want to do with the property? What's the plan for building? What's the plan for monetizing your investment in the deal? And a series of questions that start from there really lead to like a lead time checklist of things that you really need to be doing. Where's your equity coming from? Where's your financing coming from? Did you understand your business pro forma and talk to your architect to see what you can build? We start and we kind of point you in the direction of each of these guys to see what they do. For example, one of my first real questions is really, where's your money coming from?
That question is probably going to make or break the decision of whether somebody's going to go ahead with their deal. Where their money is coming from is as important as the next question, which is, how much money are you going to make in the long run? And what becomes your level of success? Because getting money up front from lenders can be 5% money from one and 10% from the next and 15% from the next. But the question is, why am I doing this? Am I building something so that it can look pretty, or am I building something so that I can make money? And where the funds are coming from are going to be questions that will need to have answers like, how much is the project going to cost me? And how much is it going to yield me when it's built? But primarily today, the question is, how much does a project cost to build? And what will it look like? And that's really where we're going to go over to the architect.
I think if the question was, what's the first phone call? I think it starts here, and then it goes down, and then it comes there. It starts.
There seems to be a war going on here as to who the first phone call is. I love it.
I believe it starts with an email, just with an address, and the client will send just a simple address or a WhatsApp message. What can I build here? And we'll do a zoning analysis. And there's a lot of, especially today, you asked to make deals work in New York City with the 99 units. It became more and more complicated. The regular 100 by 100 lots are all developed already. So you have to be creative. And once you have that zoning analysis, that's when the client will do an underwriting. And then once he knows what is the construction going to be, how much am I going to have to spend, and what I'm going to be able to get, my unit mix, how big my units are. And it all depends on what neighborhood it is. I had a side conversation. If it's in a high-end neighborhood, you want to maximize your zoning and see every deduction that you could get. Today's day and age, there's a lot of Section 8 deals, or it used to be HPS, mainly Section 8. It's a completely different ballgame. On a Section 8 deal, the mindset needs to be, how can I minimize? Because the less I spend on construction, the money doesn't change. So once you have you know what you could build and what you have to do, your parking requirements, how many buildings are you going to have to divide it, your height restrictions, am I going to be able to do high ceilings, low ceilings? Once you know what kind of deal you do your underwriting, then you go to financing, say, listen, I have a deal that is a 8 cap, a 9 cap, what kind of financing you think you can get me? And that's when it goes into financing.
Now, I met my attorney, I got my financing, I spoke to my architect, we pull a title report, and where do we go sideways on it? Where can we possibly go sideways on a title report?
Well, I didn't think about this beforehand, but I was talking to Larry about this before. I got a phone call from a client while we were in the waiting room, and he asked me, is there an easement on this property I just closed on? I said, how am I supposed to know? I'm standing at a show. I'm not in front of my computer. So he sends me a copy of the survey. On my phone, I look at it, and I'm like, yeah, you got a driveway easement. He goes, but Mark, I'm a builder. There can't be an easement. Why didn't you tell me? I said, you're looking at a piece of paper that I sent you. It's in my title report. There's an easement there. He goes, oh, I didn't realize I have to look at it. So if you're asking how it can go sideways? Like right now, 10 minutes ago, he found out there's an easement, and obviously he can't build on the easement area, and that changes his whole deal.
This happens quite a bit, actually, and the role and responsibility of who should be explaining title to developers, their architects, their construction team, that really should be solved during the diligence period under your contracts, all of it. It's not the title company's job other than to identify it. It's really the real estate attorney's job to explain to you what it means to your project, even if that means coordinating with your GC and your architect from pre-contract signing, even if that's what it means, because each of these little title encumbrances, and I call them little, some of them can be big, they affect how we do it. I mean, you get a title survey, but you also need to get your architectural survey at the same time, and building in things like party walls in Brooklyn and understanding the easements that are across and the utility lines that you have to move. That lengthens the time that you're going to be spending money on interest on your construction loans. And if you can get ahead of those issues during your diligence period or even pre-contract, and you understand what your timing is, you can do what I like to call shorten the story. Anytime you're going into a financing project, you really want to shorten the story for your lender. I learned that about 20-something years ago during the real biggest downturn that I've seen in my career, which was 2009, 2010, and I was trying to put up a 40-story tower right on the waterfront on North 6th Street in Brooklyn. And we were going for the biggest packages of financing, tax credits, HUD financing, et cetera. And we went in with this big story about how we were gonna do this, that, and how we only had to raise this money. And one of the lenders just looked at us and said, make my life easy, shorten the story. And I think that's really, in an environment like this resembles it because there's chaos out in the markets. You really wanna just get your ducks in a row, check your boxes, and make the lender's life easy.
Well, for every challenge, there's opportunity. You talk about easements and things of that sort that do come up along the way. But within that, and with the right structure on financing, you can always use the opportunity. We had somebody in the outskirts of New York, outside of New York City, who had found an easement also a little bit later in the process. But by buying the property next door to that easement, they were able to combine all of it, sold the easement back to the city, created a ground lease, and now they were able to put their affordable into a smaller building and leave their building free of any affordable in their primary building. So yes, those things do come up, and I agree with Larry, shorten the story, but don't miss the details along the way.
And I'll just add to that, don't miss the details on violations or judgments that you're going to inherit. I have someone that bought a property in Brooklyn and was subject to about $113,000 in penalties that they inherited. Those penalties I couldn't get waived even though they were a new owner. Or they had to change a roof on a building, and one of the city agencies said, the city agency was requesting they change a roof, and the city agency was insistent that they change the roof from the slab, from the joists on out, until I fought with the city agency and was able to get just a replacement roof put on. The difference was between $500,000 and $600,000 on that new roof.
I would just add, to shorten the story, understand the story. If you understand it, if the lawyer understands and the lending department understands what is the story, why are we doing this, why are we doing that. We're just finishing a 500-unit building in Brooklyn with 99 units. It was the first project in the city that divided because of 485X. We went to 3 lenders just because they didn't understand the story. They didn't understand, why are you having these seismic gaps? Why are you having these? Understanding the story, There's a saying, if it's missing in Asbara, that means you don't understand. It's missing in Havana. You don't understand it. Take the time to understand it, and for the client, take the time to tell the story. What are you trying to do? If you understand it, it's much easier.
Just for all that don't know, missing in Asbara, if it's missing an explanation, it's missing in Havana, it's missing an understanding. Just to give it the literal translation, so everyone's on the same page. And then always there's that hiccup with the title, and there's then the hiccup with the violations and the expediting, and all that goes sideways. Mark, how have you seen title reports, and what have you seen in working conjunction with attorneys and with banks, where they've stopped a deal because of X, Y, and Z that was in that title report?
I guess the story I just told, but there's, unless they buy the house next door and terminate the easement, I have no idea how he's going to be able to build. He can't build there. The old lady's parking her car there. So unless he buys the old lady out, he's not going to be able to. And this could have been solved if they actually looked at the report beforehand.
Are there other things besides easements that you've seen that have been hiccups in title reports, besides that?
There's always hiccups. There's always judgments that have to be taken care of, violations. I just send that part of the report to you.
Oh, thank you very much.
Yeah. I don't send them anywhere else. As long as there's no hiccups that you can't get through, as long as we work together and we do the due diligence.
So the goal in today's day and age seems, as Shaya, you and I were discussing, to think outside the box. It's not what it was 10 years ago. I once wrote an article a number of years ago, and I wrote it, the title of the article was, "It's not your grandfather's city." What your grandfather was able to do, what your father was able to do, you can't do any longer. Because it's not just city, not just New York City, it's New Jersey, it's throughout the country, throughout the world. So what changes have we seen, and what suggestions are you making? Ben, you had made a suggestion that know your numbers, know your consultants, and get the teamwork done, and don't be so focus on the paper and not on the as-built, because it costs so much after to change things. What changes have we all seen post-corona, or in today's day and age, or with the interest rates as they are, et cetera, that you would advise people to, besides just the title report, but advise people to really keep their eye on and zoom lens into?
I think probably the idea that things will be the way we anticipate them being is the greatest misconception in construction. How many people say, I will build this and it will yield me this? We're going to build 100 units and we're going to make X amount of dollars. The idea that something will cost what it is going over to the architect, he'll tell you that there's always an amount of money that you have to expect is going to be above and beyond. You can go to legal or to title and they'll tell you there are things you certainly don't know, we're just not sure what they are yet. And certainly from the banks, one of the worst things for a lender is when a deal gets stale. When a deal is sitting, waiting for the architect to finish his job, waiting for title to clear up an issue, waiting for legal to understand perhaps a brownfield tax credit or a related issue, a CPACE additional financing. And for every day that a deal lives is another opportunity for something to change in the world and for that lender to say, this isn't going to work for us. There's another opportunity for New York City to say, hey, we want to change rent control again and make it more difficult for you to achieve the yields that you thought you were going to yield. So knowing your deal, getting the story quickly and understanding it is equally as important as doing it quickly and getting it done. Because deals will fall apart just from sitting. Going on vacation is not really an option anymore.
What I've seen in the last, the new thing, what makes deals happen, the way that I see it, is speed. The way that people, from when they get into the deal till they have tenants, became extremely, extremely efficient. And I think this is where the people are finding, the developers are finding their money back. They're spending much less time in hard money and in construction loans. The name of the game today, it used to be one or two contractors, used to be very fast. Today, everybody is fast. The buildings that we see are longer on paper than they are on field. There are certain 100-unit buildings that go up in 6 months, and that's the new norm. It used to be like, wow, This is and developers are telling me they need to find ways to make their money back. The land is so expensive, construction is so expensive, so when they're saving 3 months or 4 months in insurance and all of that, that's where that makes a difference. So knowing your numbers in the beginning, and if you want to do speed, what I've seen is you can be greedy. And we all know the triangle. And that's what I said, know your numbers. You know what cap rate do I need to be? This needs to be my rent roll. Then talk to your architect, talk to the zoning attorney, see if you could make it better. But don't make a benchmark, and then when you get that benchmark, say, okay, now I have a new benchmark. And then when this is the benchmark you want, don't be greedy. If you want speed, know what your numbers are and just run with it.
Ben, it sounds like you're saying, like they say on Wall Street, the bulls make money, the bears make money, and pardon me, folks, the pigs end up last. Sounds like you're using that term. How does this change? We're talking mostly about development properties. How does this change them on investment properties with upside potential? Whether it be adding on floors to a building or renovation, or does it change it all when you go from development to investment with some upside potential?
I might jump in here. You know, what Ben was focused on was things like understanding your pro forma and I'll say predicting your cap rate. And I think everyone in this room has a broken crystal ball at this point. If anybody can tell me what the cap rate will be in 2.5 years, let's have a conversation after this session.
We'll pay the person.
But that's really one of the earliest questions that I get is how to change the exit cap rate. And I can't predict where interest rates are going to be in that time frame. We do know that interest rates and cap rates are correlated over the last 2 decades, that they tend to run in line. We know that. So where do we find extra? We can cut costs, and you can do that through legal structuring on your contracts for investment properties. You can do that. You can do it through tax planning, efficient tax planning, joint venture structures. You can use different financing structures to reduce upfront costs and delay the need for money. And so when you're talking about investment properties and how to add value, I think when Ben says understand your deal, he's speaking in very specific terms of understanding the pro forma. From there, if you see where the breaks are and you see that interest is going to run for 24 months, if I can get you a contingency period in your contract until you have permitting on that refinance, that renovation, for example, that 8 months of interest that you didn't spend, that maybe you gave a little upside to the seller, for that time period, that's accretive to the deal. You get it. I think other things that we're seeing is, looking at title and looking at neighboring agreements to see what else we can do pre-project. Can you get your underpinning agreements? That's development again, sorry. But if you need a neighbor agreement, a license agreement for monitoring to add floors, can you do that before you are under the burden of a construction loan?
It sounds like you're saying that due diligence, that team mentality, as Ben wrote in his email, due diligence. I reached out to everyone beforehand to hear their opinions and their thoughts of things to discuss. That's what I mean when I say his email. It seems that team mentality and the due diligence are of utmost importance.
I'd agree with that. And then actively executing on your deal. I mean, I see guys kind of disappear and then wonder why their deal isn't done.
If I can just agree about cutting costs, the only place you should not try and cut costs is on your legal bills. And I'm saying that, it sounds like a joke, but the truth is, dealing with an attorney who understands the legal side and almost as importantly, understands the business side and actually does the work, saves you a lot of headaches in the end. I can tell when I'm dealing with an attorney that knows what he's doing, who's a seasoned professional, and then someone who doesn't always cause a lot more hiccups. So when it comes to legal counsel, cheap is expensive. Don't save money there.
To pile on a little bit for Larry, when lawyers get involved in a deal and don't understand the elements, they don't understand the nuances of the financing, they don't understand what it means to have 2 or 3 lenders at the same time because you perhaps have a C-PACE lender. Maybe you've gotten a USDA loan because you found that one piece of land in New York that still qualifies. And then you have a bank lender on top of that. There's recourse on one, there's non-recourse on the other. Without a lawyer who can really understand the pieces, you're going to sit for days or weeks while they try to figure it out. And even if the result is one that you like, you'll have spent far more money at that point in time.
Wholeheartedly agree with that. I think the role of an attorney is sadly said to control the uncontrollable. And that's something that really sounds like an oxymoron in statement, but in practice, it means getting ahead of the deal, understanding where the breaks are, not letting anybody get on the phone and say something that's going to delay your deal until you know exactly what they're going to say. You know, they say in litigation, you know, don't ask a question you don't know the answer to. Don't say anything to a lender that you don't have an answer for.
Well said. Mark, how are you finding that on title reports with attorneys asking you to omit this, include that? How do you find that impacts when you're talking to attorneys that are more knowledgeable than that?
So the more knowledgeable attorneys understand the product that we're selling, and we're not in the risk assumption business. So when they say, you're the insurer, just omit it and you have to take the risk, that's not what we do. We're in the risk elimination business. That's why we only get a one-time premium, good for the life of the loan. You don't have payments every 6 months because it's not risk assumption like property and casualty. So everything that we do is to eliminate all of the risk before you close on the property.
Can I add something for Mark here? I'm going to ask you the question. I asked you it before, and it's something that's in my mind. What percentage of construction projects are underinsured?
Oh, from the title perspective?
Yes.
Almost all of them. You're buying a piece of land for $2 million, and then you're taking out a $100 million construction loan. Don't even waste the money on the $2 million policy, because if the building's worth $100 million, you're getting no coverage on your $2 million policy. I would always tell people, buy for the future value. We can, in New York for sure, we can do that, and we will put in a pending improvements clause, and as long as you can prove that you made improvements, you're going to be covered for the full amount. But if the fair market value is $100 million and you bought it for $2 million, you're severely undercovered.
So in the area where we have projects that require upfront soft costs to prep it before we can bring in the construction loan, before we can get into the ground, where we're still paying architects, we're paying expediters, we're paying permitting fees, those values aren't covered.
No, I don't think those values are going to be covered. It's going to be the fair market value of the building, bricks and mortar.
So
I don't know how you get the soft cost covered.
can we get the policy endorsed? Is there anything we can do?
I don't think that there's an endorsement specifically for soft costs.
So until I
As
get
far as I know.
to the financing element,
That's not. It's,
we're
yeah.
taking the risk on that
Yeah,
money.
yeah. It's not a title insurance product. I mean, when you're talking to your architect, your due diligence is not. It wouldn't be covered.
But if I bought a policy, a $2 million property, but I also knew I was going to be spending another $2 million on soft costs to get there, could I buy $4 million at that time?
You can buy the policy. We can put in pending improvements, and you can make the argument that these soft costs were towards improvements. I don't know what would happen if the underwriters would pay out or not, but you can definitely make the argument. But the bigger issue is on the actual hard costs. Your owner's policy is only going to cover you for what you paid at the time, unless you buy a policy for the full amount of your after construction value, which is guesstimated. You know, it's not, you won't have that number 100%. You don't know what the market's going to be like in 2.5 years, as you said before. But if you don't do that, you have almost no coverage. And I don't want to tell this to people, but then don't even buy the owner's policy at all.
That used to be the joke that once I got the title report cleared, I didn't need the policy.
Does this include, Mark, does this include the same thing on investment property? Let's move from development to investment. Is it the same situation?
Well, if you're buying a fully developed property as an investment, you would presumably buy the policy at the fair market value, which is what you're paying already.
Right, when I say investment property, I'm sorry, I didn't explain myself. Investment property with an upside potential where I'm planning to do renovation or I'm planning to add square footage, et cetera. I didn't explain that.
If you're planning to add value to a property, you should buy the additional coverage. So you take your purchase price and you say, I'm putting in $10 million, you should ask for an increase in the policy. And again, we'll put in a pending improvements clause, and as long as you can, if in the event of a complete failure of title, a complete loss, if you can prove that you actually put in $10 million of value, you'll be covered for the full amount.
This is quite unlike the financing side. I would ask any architect, how often are you being initially paid from your initial meeting out of financing? Our experience is none. Most people are coming before the financing is lined up. However, the financing will capture the work that you do. It will capture the soft costs that you put in, but I caution everyone, be within a market, because if you're going to go to 4 different architects, nobody's going to like to pay for all 4 of them.
The architecture, our bills get paid before financing is in place, and I always tell the clients, my bank, when we collect money, my bank didn't come in. So we always tell them we're not the investors. We want to give us a piece of the deal, and it's very hard till financing comes in. There's a lot of money that goes into soft costs, attorneys, expediting fees, structural, mechanical, but eventually I see that once the financing gets in place, they get the money back. So, and if you're a repeat customer, usually the architect and the expediter will work with you that you should have less payments before. We work with our clients on that aspect.
For 40-something years, I've been telling clients, if you don't want to pay my bills, that's perfectly fine. But when you refinance or when you sell, I would like my 5% profit of the deal. No one has yet taken me up on it. I would do much better.
I once had a client that tried to bargain down on the price. So I told him I sent him back a contract with the original price. And then I told him every bill that is paid within 30%, he wanted like a 7% discount. So every bill that will be paid within 30 days will get a 7% discount. He didn't take it.
Makes sense. Shaya, how are you finding with getting construction loans, whether it be...
I do want to say one of the things that did change, yes, what changed since COVID, people don't work for free anymore. It used to be that architects, engineers, everybody let big bills pile up. We stopped borrowing money to pay payroll. I always tell my clients, we sell hours, that's what we sell, and we'll give you 60 days, 90 days, but people stop jobs. We've been doing this for 15 years. Now is an era that people even big clients, if there's no money, we can't continue working on projects. So that's a new mentality in the service business.
Life has changed post-corona. Shaya, how are you finding with getting construction loans, whether it be on development or be on investment property, with upside?
Well, the truth is that they're similar in the world of financing. When I look backwards at time, I think it was around 2005, I worked on a project in Lakewood, for those that know, a small town in New Jersey. There was a project called Washington Square, which was being built, and we looked for financing there. We went to maybe a handful of lenders, brought the lender down to the property. He saw the plans, he liked the deal, and we closed shortly after. It was a very, very simple process. It was a small room of decision-making, not a complex project. Fast forward that to today, most deals are taking months to get done. The lenders have gotten smarter. There's a word that I'm going to use that I challenge any panel at the boat to not say, and that's the word of AI. Every lender has to be wary of what documents are coming in that were written authentically or not, what numbers were given authentically or not. These things have to be checked and double-checked and triple-checked. The other thing that changed dramatically is the uncertainty has become much greater. And I'm not even just talking about uncertainty. Larry referenced interest rates, cap rates, but I'm even talking about things that the architect will give you. The architect will put in a certain structure, something that is more efficient for energy, something that's more efficient. And in 12 months from now, we may find out that efficiency has other ripple effects. We may find out that those very efficiencies are going to cost you more money on the roof or on porches, or I don't know that business as well, but I've seen it too many times. Capital is out there. There's a lot of money out there, and there's a lot more of the money that people don't know about than the people do. There's a lot of tax credit money. There's USDA financing, there's HUD financing, which is not as popular in New York. But there's a lot of money out there that helps people take less out of their pocket and get more on the financing, and ultimately that will create a higher cash-on-cash return. But that process is longer and harder. I want to talk to one thing that you said earlier, and that is the past is equally important to the people giving money as the present. You need to come in with somebody who has experience. If you're using an architect firm with 15 years of experience and a title company with 20 years of experience and a lawyer who's done this for billions and billions of dollars worth of investing, the lenders will be much more open to lending your money. If you're going to come in and save some money by getting the new guy down the block, getting a title company that missed the easement or whatever it might be, you're going to
Or
end
gave
up,
you the cheapest price.
correct. Those will cost you without a doubt, and every time will cost you in the long run, because the lenders will come back and say, do we have the confidence? Keep in mind that the one person who wants you to fail is the lender, because they will get this project back, they will finish it, and they will be in it for less money than you are, less time than you are, and less sweat than you are.
Wow. Wow. I have to digest what you said. While we're digesting, Ben, tell us how the city of Yes, in New York City specifically, the new J51 or 485X is affecting, or the old 421A is affecting how all these programs are affecting how people are doing business.
City of Yes City of Yes just simplified the zoning, and after 60 years redid it. There's still a lot of things that keep on coming up, but overall, it made it much easier to develop projects. It made it simpler. A lot of things changed in downtown Brooklyn and in Manhattan. They took away density, rear yards, side yards. It made it easier to going back, because the regular 100 by 100 lots are not there anymore. You need to find complicated lots. It made it easier. 485X is a challenge. The challenge is the 99 unit cap rate. If you have to cap it by 99 units. If you do above 99 units, either you condo it out, so you do, and it's a theory. I don't think anybody has yet did it yet. The theory is that you do, let's say, a 200 unit building, you take 99 units as one condo, and for that you don't take, you get a tax credit, and then for the other 99, you do pay tax. We've spoken about it. We're actually doing a project now that has rentals and sellable condos that we're playing around with. But it's a challenge. There's a lot of articles written about it, that years to come we'll see what happened that New York City has so many 99 unit buildings. The ultimate goal is to change it. The city knows about it because we're doing a couple of thousand units now, and they're all 99 unit buildings. We have a project that has 27 99 unit buildings, and they share elevators with easements, and they have walls in between, and that's where it comes with taking risks. We don't do potty walls, for example, on these buildings. We do seismic gaps. It costs a lot of money because we don't know at the end how the state is going to look at it. So it's the 99 unit thing is a challenge, but we're figuring it out. And by the way, with lending, what we see with these projects, that because they're 99 unit buildings on one tax lot, we have certain projects that have 3 different lenders. And it goes 1, 2, and 3, and there's a million emails, and every lender wants to see the other one. And that's where it comes, understand the story. If lending team understands the story and legal team understands the story, it saves a lot of money and time for us, just because he wants to be first, he wants to be second. And if this one fails, and if that one fails. Another big thing about City of Yes is parking. Parking got reduced by a lot. In most areas, it got eliminated. It depends. No, certain places you want to do parking, then you could still do it. But if you don't want, if parking is an expense for you, you could get away with most places. You can get away with no parking.
This is where you need a good quarterback and a good title company that's going to pick up and handle all the moving pieces as they keep moving, because they seem to be moving simultaneously. As I once heard from Rabbi Beryl Wein, Olav Shalom, be prepared for the curveball, because the curveball is coming your way. It's the only thing that's guaranteed. That curveball is going to hit you. So wear your catcher's mitt 24/7. Rest in peace. To wrap things up, Mark, you want to just finish off and we'll work our way down that way. What would you advise people to focus on? In 1 or 2 sentences, what you advise people to focus on and keep their mind zoom-lensed and focused on?
So when it comes to development, it's crucial to again, with good counsel, read the report. You're paying for it, you're taking the title insurance, know what's there. Because the guy that I was talking about before that had an easement and didn't read the report, he has full title insurance, but he's still subject to that easement. So if he would have actually read the report, he may have found himself in a little bit of a better situation than he's currently in.
I think you're quoting Cy Sims and saying an educated consumer
Best
is our
customer.
best customer. Put it mildly. Larry,
I think the takeaway that I would love everybody here to understand is that you can control the process and you can shorten the story that you tell to your lenders. You can get ahead of transactions. And working with educated counsel, whether you have to educate them yourselves or you find people that you know and trust and you bring them in and let them talk to your consultants, let them talk to your architect, have them talk to your mortgage broker, and make sure that they truly understand the deal and can control the narrative.
Shaya?
I think that people who are developing, whether it's ground-up development or they're buying an investment and making it bigger, making it better, are dreaming. They're dreaming of something. And I would say the same thing on the capital side. Don't stop dreaming. The amount of times people came to me and said, I want to do this, and I was told it's not doable. There's always an angle. There's always a solution. Don't stop dreaming. Don't stop pushing. And don't let a mortgage broker or a lender tell you something is impossible. There's always another way.
Okay, when we stop dreaming, the game is over, I see.
I would say 5 points, if I may. I'll make it quick. First thing is, as we said, know your numbers. Know what kind of developer and what your numbers need to be. Bring in consultants early. Bring in the title company. Bring in your counsel, zoning counsel, whoever you need to be, your financing. Bring in people early so you know what you need to do. Make decisions and stick to it. Once you know who your team is, what your numbers are, don't keep on changing. Don't keep on raising your bar, because every small change changes the numbers for the lawyers, changes the numbers for the deal. Stick to your numbers. Spend more time on paper. It's very expensive once you're in ground. I know everybody wants to go in. We closed on the deal. I want to be in the ground. Bring me into the ground. If you go into ground before you're fully coordinated, and it's never fully coordinated, but at least at 80%, you will spend much more time in aggravation. So it's much cheaper and simpler to change things on paper. And the last thing is to take ground and to put people living on that. And these big projects, you take a big piece of land that used to be whatever it was, and you have hundreds of people eventually cooking, eating, spending time there. Takes team effort. And it's very easy when things go sideways. They say, oh, legal missed it, title missed it, the lender missed it, structural engineer messed up. It's very easy in any given time to say other people made a mistake. If you have a team mentality that we know that we're fulfilling the developer's dream and we're doing it together, then every mistake and every challenge is usually very easy to fix.
So all of these suggestions go back to shorten the deal and driving the deal. And the developer, the owner, the investor has to be in the driver's seat and assemble their team in the best way possible early on and stay focused on the deal like it's the only deal in their life when they're on that deal. Go on to the next deal. Or have someone that is going to be zoom-lensed, focused on that deal, breathe it, eat it, sleep it, drink it, and live it 24/7. Is that what you're all saying?
Yep.
We wouldn't have had a whole session. What are we doing over here? Thank you all very much for coming. I hope we were informative and entertaining to some degree.